Good morning, folks, and welcome to a brand new episode of Finmet Mondays. Today's episode is going to be a recap of last week's events that led to a $100 spike in gold. It is also to convey what the technical outlook for gold looks like this week. So let's get right into it. The first major development last week was Chair Powell reiterating that there are probably going to be interest rate cuts this year, although he did not confirm when and what would the magnitude be, but participants are expecting it to be the 12th of June 2024. And anticipation of this development is what was the major catalyst in the rise in gold prices. We see that there's a 57.2% probability that there's going to be a 25 basis point rate cut at the 12 June meeting. The second one was the non-farm payrolls and unemployment rate towards the later part of the week. Now, the non-farm payrolls numbers, which is the number of jobs that are created in the US on a monthly basis, this number came much higher than expected, 275K versus a consensus of 200K. So although this was positive, but the unemployment rate numbers was where markets were confused as to how to interpret how the labor market is doing. There are definitely signs of softening. There are definitely signs of stress, and the unemployment rate rising to 3.9% is an indicator of that. The unemployment rate, as you can see, was always around the 3.6 to 3.7%. You see three bars that are exactly the same, and suddenly there has been a spike. So this was the second development. The third bit of news that came over the weekend was China's consumer demand rising by 0.7% on a year-over-year basis. This is really positive because the demand from China really dictates how gold demand also works. China is one of the biggest consumers of gold. An indication that their inflation is rising and they are not facing growth concerns is a very positive sign for not only the Chinese markets, but also for the economic markets and also for gold as a result. So it's a combination of dovish remarks from Chair Powell, the unemployment rate in the US increasing to 3.9%, and Chinese consumer demand over the weekend coming in strong. All of them have really helped gold achieve this $100 spike. Let's look into the outlook for gold and really try and understand from a technical standpoint what seems to be happening. Currently, we're at the 2178 level, which is much above the most recent high that we had seen, which is 2147. Now, where do markets go from here? We have one resistance here at 2200. We have another resistance at 2250. Both of them are going to be potential roadblocks for further rises. Why do I say that? Let's look at the momentum indicator. The momentum indicator suggests that prices, definitely the momentum has been rising. There's been a lot of bullish momentum. But if you look at it from a 4-hour basis on the 4-hour charts, you see the momentum is slightly tapering. We've hit certain ceilings here, and the momentum seems to be on the downward trajectory. So that's the first indication of slight slowdown in the bullish uptick. Secondly, the markets that have risen by 10% from 14th of Feb, right from 1982 to all the way to 2178 right now, this pattern also took place back in October. In October, we were at 1800 and the markets rose by 10% back then to 2008, creating fresh time highs over there. So this 10% run up is something that we saw not too long back, about 3 to 4 months back. And as you can see, after it rose by 10%, it has seen a slight pullback of about 4%. And that's something that we also expect going forward. So if I literally trace 4% over here or 3 to 4% over here, this somewhere retraces back to 2100. So this is what we are expecting, that because the momentum is slowing down, we also have some key economic indicators that might pause gold's upside. Here is the first retracement that we are expecting, which is from the 2178 to below the 2146 pivot and somewhere settling in this 2120 to 2130 mark. In the near term, this is what the outlook looks like. However, breaking this 2146 pivot is going to be the first challenge, and only if that is possible is when you're going to see a progression towards the 2120 level. One of the other factors that is also key for gold's downward slide that we may expect this week is how the dollar index is performing. There are strong flows in dollar index's price action that would need to be sustained or that would need to be broken before we can expect simultaneous rises in gold. We would want these two supports, which is one at the 102 and one at the 100 level, both to be broken for continued rises in gold. Now, what are the developments that we need to look forward for? The first one is the core inflation rate. The CPI reading last month in February, that came in exceedingly high. We can see the chart here, the last bar Markets were expecting inflation to moderate, and CPI comes in and says inflation is still pretty much sticky. So this is the first reading that participants will be looking forward to ensure that the bullish run can continue. On Thursday, we will have the producer price index, another measure of inflation, but measured from the producer side. And lastly, we'll have the retail sales as well, which is an indication of how the consumer demand is also shaping up month over month. So broadly, on Tuesday and on Thursday are two major indicators that we would need to look forward to. Outlook for this week remains that we might still see a slide in gold because of the highs that have been created. But apart from that, the bullish run is firmly set in terms of technical posturing, and we would expect in the medium term the bullish run to continue.